Welcome to Aging Well, Living Independently. Today's roundtable is about guiding families through one of life's biggest transitions, planning the next chapter for aging parents or loved ones with disabilities. Let's be real, housing, insurance, and life in general aren't getting any cheaper. Even a lifetime of savings can shrink faster than expected. Families are often faced with tough choices. How do we protect our parents' independence, their dignity, and security while balancing the financial realities? And that's why we brought together a panel of trusted local experts in real estate, finance, insurance, gerontology, and lending. You'll hear practical solutions, real life insights, and discover local resources you might not know existed. But here's the good news. There are answers, there are options, and today you're going to learn them.
When we talk about aging adults and individuals with disabilities, one of the biggest challenges we see is housing. Finding something that's both accessible and affordable, and in a location close to healthcare and community resources that can feel impossible for many families. On top of that, there's the financial side. Rising living expenses, healthcare costs, and fixed incomes create a lot of pressure. And often, family roles change dramatically. Adult children may suddenly find themselves managing finances, arranging care, and making housing decisions. The tricky part is finding that balance between independence and the right amount of support. And there are a few common misconceptions that can get in the way. First, that aging automatically means moving to assisted living. In reality, many people can stay in their own homes with the right modifications. Second, that a disability means you can't live independently. But with the right resources, many people absolutely can. And finally, the belief that family support is enough on its own. The truth is, even the most committed families often need help from outside resources to make independence sustainable.
So we've learned about some of the issues, the hurdles that families face these days. So let's bridge the gap and let's talk about solutions now. How can a mortgage product actually help you? Maybe address some of the questions you've had before. So did you know you could actually buy a home for your parents and still get the exact same loan terms you'd get if you were buying a place you were going to live in yourself? Most people, even a lot of lenders, don't know this even exists. It's a special exception to the rule. And if you qualify, it can save you thousands of dollars and open the door to your parents having a safe, comfortable home without putting their finances at risk. So here's the situation. I see it all the time. You've got parents who can't qualify for a mortgage on their own. Maybe they're on a fixed income from Social Security. Maybe there's a disability involved. Or maybe it's just their credit file just doesn't work for today's lending guidelines. If you try to buy a house for them the traditional way, it gets classified as an investment property. That means higher down payment, higher interest rates, and some more restrictive terms. So another option, co-signing. But that can hurt their credit, put them financially at risk, and sometimes it's just not even possible. Here's where this primary residence exception comes in. This rule says you can purchase a home for your parents, even if you don't live there, and the loan will still be treated as a primary residence loan for you. That's amazing. I'm gonna tell you that's a game changer. The requirements are simple. Number one, your parent has to live in the home as their main residence. They must be unable to qualify for the loan on their own due to limited income or disability. You as the borrower own the home, make the payments, and control the property, but you get the full benefits of the primary residence financing. So hope you caught that. That is huge. So we're going to cut there. So what does that mean for you in real numbers? Lower cost. Down payment can be as low as 5%. Better interest rates. You get the same competitive interest rates as if you were buying your own primary residence. There's no location rule. The home can be anywhere. It can be next door to you or across the country. You have protection of your parents' finances. They don't have to co-sign. Their limited income or credit will not be on the line. It's a simple process. This isn't a special high-risk program. It's a standard conventional financing with normal documentation, no inflated asset requirements, and no extra fees. So let me give you an example. I recently worked with two clients who wanted to buy a single-story home for their retired parents. Without this program, they would have needed 20 to 25% down payment, and the interest rate would have been much higher. Instead, we used this occupancy exception. They only needed 5% down, got a fantastic rate, and we closed in under 30 days. Their parents are now living in a safe, comfortable home that fits their needs, and their daughters were able to keep more money in their savings. So it's a win-win for all sides of the family. Another great thing about this option is flexibility. If your parent's situation changes down the road, maybe they move in with you, they pass the home back to you, you can sell it, refinance it, repurpose it, however you need to. It's just a solution for today. It's a smart, long-term investment in your family's future. So, if you ever thought about helping your parents or even an adult disabled child with housing, this is one of the most affordable, stress-free, and financially smart ways to do it. Most lenders won't even bring this up because they don't know it exists, but we do. If you want to see if you qualify, or you just want to run the numbers, reach out to us. I'll walk you through every step so you and your parents can have peace of mind about their home.
So if you're still watching this video, well, kudos to you, but also this is the time to share it because I promise you, you're not the only one considering this scenario. Everybody wants their loved ones to either move closer to them, be supported where they are. Life changes. Even your children with disabilities are ready to be independent, and they should be, yet they need that help. And your desire to help isn't always met by your finances. Well, this is the gap that we have been needing to let you know about, because just like Russell mentioned, not even lenders understand this, and it is available to you. So why is this important? Let's talk about moving to our area. Southeastern North Carolina, you have affordable housing anywhere between $300,000 and $500,000. Well, hey, if you're looking to purchase as an investor, that's a whole lot larger of a down payment, 25%. Yet this loan is giving you the opportunity to purchase as a primary purchaser. So what does that mean? The difference between 5% and 25% down on those purchases with a $300,000 home, that's the difference between putting $15,000 down in a down payment or putting $75,000 down. That's a $60,000 gap. It's obviously even larger with a $500,000 home, and believe it or not, prices continue to rise. And while that sounds like a luxury product, it's not that luxury anymore. And so that very well may be exactly what you're looking at. The difference between $25,000 down or $125,000 down. I don't know about you, but there's a lot I can do with $100,000 that I may not want to put down on a home that also is investing into not only my livelihood, but the care of someone else. So you have moving needs, you have closing costs. There's so many extra fees that are attached to a purchase, whether it's inspections, whether it's just making the practicality of closing one side of life and moving to this side. All the money you can keep in your pocket is huge to making that the most successful process for you. So while it's really important to pay attention to numbers and to have the flexibility to not only move you to a space, but maybe bring your loved one with you, having this product can double your opportunity. It keeps more money in your pocket and makes an available option to you. The other great thing is, just like Russell mentioned, you can do this along with other family members to help take care of that parent. So it's not all on your shoulders. We're going to talk a little later on about even some benefits that come on the accounting side, still benefiting as an investment, even though it's a primary. There's so many great aspects to this opportunity that starts with having more purchase power in our area for you and your loved one.
So today we'll identify eligible tax deductions and credits. So we'll run through first two scenarios. The first scenario, if you do not charge rent as a caregiver. So, you know, the caregiver purchases the house and does not charge rent to the parent or child, you may be eligible for itemized deductions on Schedule A. So some of the deductions that you may be eligible for is the mortgage interest deduction. So you will be able to deduct qualified mortgage interest expense if you itemize. Starting in 2026, you'll be able to deduct mortgage insurance premiums, PMI, which will be restored as an itemized deduction. And then also, you will be able to deduct property taxes. So starting in 2025, the state and local tax deduction limit raises from $10,000 to $40,000 if you file married filing jointly, $20,000 for married filing separate. There are phase-out limitations based off modified adjusted gross income. Then also, you may be able to deduct medical home modifications. So the cost of accessibility features, ramps, rolling showers may be deducted as medical expenses. However, there are limitations to these deductions based off filing status, modified adjusted gross income, debt incurred. So it's always best to work with a CPA or qualified tax professional to ensure that you qualify. The second scenario is if you charge rent as the caregiver. In this case, you would report on Schedule E the rental activity. So you would pay tax on rental income. If there is taxable income, you are able to deduct rental expenses to offset your rental income, such as your mortgage, interest, your property taxes, utilities, repairs and maintenance, depreciation, and insurance, as well as medical home modifications. And so the beauty of this is you may be eligible, if you have rental losses, you may be eligible for this to offset your active income, your W-2 income, if there are rental losses. Then we'll also jump into credits. So there's three major credits that you may be eligible for in this scenario. And you must have a qualifying child or qualifying relative. You have to meet certain requirements. So the first credit is child and dependent care credit. This is the credit for qualifying expenses that were incurred to support the child or dependent during the tax year. Also, there's a credit for other dependents. So up to $500 credit per dependent if they don't qualify for the child tax credit. And then lastly, the child tax credit up to $2,200 per qualifying child under the age of 17. And then also financial planning and budgeting and cash flow considerations that you want to consider if you're purchasing a home is to ensure the mortgage payment doesn't crowd out essential services that have to be provided. So you want to plan up front. You want to build a budget. You want to identify the cash outflows, determine the total cost of ownership beyond the mortgage payment. You want to factor in the insurance, the property taxes, repairs and maintenance. And then you want to work with a financial planner or CPA to help build this budget for you. And you also want to include in this budget the estimated ongoing care costs and integrate that in the monthly estimated costs into the budget. And then once these cash outflows have been identified, you want to ensure the cash inflows meet or exceed the cash outflows. And one of the things that we always recommend is to have an emergency fund for 3 to 6 months of expenses for unexpected health needs or other expenses that may come up. And also, if you have money invested, work with a financial planner or CPA to ensure that the investments are providing the necessary cash inflows, the returns, the dividends needed to support your parent or child. And then lastly, we want to talk about benefits, protection, and ownership structure. So it may be best to avoid direct ownership for supplemental security, income, SSI, and Medicaid recipients. So owning a home in their name could count as an asset and affect eligibility. So there are special needs trusts, which holds title to the home, allowing use without affecting benefits. So there's multiple ownership options out there, different ownership structures. So we always recommend to work with an attorney, a CPA, to figure out the best option for you in this situation. Everybody's situation is different. So it's always best to work with an attorney or CPA to figure out what the best option is. Is there anything you guys want to add?
Those are good points. And again, it's not just, okay, how do we buy and bring less money to closing and have good payment, but there needs to be a financial plan going forward. And that's a lot of his taxes. And especially if there's something you can help offset and make it more affordable, because there's going to be healthcare expenses and things like that. So I think that's a key point. Very good point you made.
And what you just said about, when you're working with Medicaid programs, they're going to look back at the assets for your loved ones, and that could affect their eligibility for programs they desperately need and actually should qualify for. So being able to use this loan type, like you were talking about earlier, is going to open that door for them because it is in the name of the family members and not the name of the loved one that needs the care.
Right.
It's huge.
Absolutely.
I know you have got a lot of information today from our experts, and I'm here to offer that gap with the insurance for that piece. The occupancy exception is a little different when it comes to the insurance, whereas on the lending side of things, you're able to get those credits and those lower rates for it being a primary home. On the insurance side of things, you want to make sure that you're consulting your professional in that field, so that way you can ensure that your home has the coverage that it needs to fit the specific needs of not just yourself as the purchaser, but also for your loved one who's living in the home. And making sure that the home is insured properly is definitely one step. But also, you want to make sure that in the event of a loss, that there's no additional out-of-pocket expenses that are being incurred for either you or your loved one in the home. And those include things like loss of use. If your loved one's not able to live in the home due to a loss, where are they going to go? And so different scenarios can always be addressed, but at the end of the day, making sure that you're not compromising the coverage just to get those figures where you're wanting them, it's definitely a problem that we see in my field. A couple of different things that I want to just touch base on is different aspects of insurance that may be beneficial with this occupancy exception. You have term life policies that you can customize according to the amount of years that your loan is for. And then, of course, that means if something happens to you, then that financial hardship and burden is not left on your family or on your loved one that's occupying the home. You could delegate those funds to pay off the loan, and that's one less thing they have to worry about. If you're worried about you being employed and getting injured and not being able to make those payments, there's disability insurance that could either be something short-term, or it could be a long-term thing that could pay out all the way up to retirement. There's also job loss insurance, which a lot of people don't know about. It's relatively inexpensive and it covers the mortgage directly. So just making sure that you're prepared in the event of a loss to protect not only you, but also your loved ones and the home that you're purchasing for them. Talking about credits, I know that we talked about several credits on the financial side of things, on the lending side of things, and also on the realtor side of things. You want to make sure that you're optimizing your savings. It doesn't matter what avenue you're traveling down. And so with bundling insurance, you hear it all the time. Going to one place, having one person to take care of your multiple needs, you might as well. And if it offers an additional discount, that would be great. You can have your parents' home, child's home insured, have that life insurance policy that offers you that additional discount while making sure that it's all being taken care of by the same person. One-stop shop. And definitely just remembering that since life is forever changing, renovations that are made on the home, refinances, additional square footages, if your need changes, touch base with your professionals. Let them know about these changes. That way, your policy can be customized accordingly. You want to make sure that your family is protected. You want to make sure that your homes are protected and insured correctly.
So from all of us, I just want to thank you so much for watching this video, for sticking around and hearing all of our information. As a group, we all loved coming together to collaborate to best serve our clients. As a gerontologist, I just want to say I really appreciate a group of people that are all about helping the older population specifically, but also children with disabilities. You know, sometimes it's forgotten that we should talk directly to that population instead of the person that's trying to help them. So that is very important. I appreciate you guys wanting to help with that. We are here to support you. You can please share our information. If you need any more information from us, reach out. We have a ton of programs we can share with you. We're all about education as well, all about teamwork, and we just want to make this process smooth for you, which I know all together we can do that for you.
That is awesome. And one of the things that I am so excited about with what she just mentioned is we're going to take this on the road. So if you want us to come speak to your group, whether it is a group with parents caring for children with disabilities that want to be more independent, or caring for loved ones, no matter what the age, right? We can be young and in the older parent group, but still get to qualify for this great asset. The benefit of bit of my vision I see in benefiting these communities are we could start to see people have this awareness, come together, and even locally, maybe make purchases for those loved ones in the same communities, start to gather groups that get to meet up and have that support, not only for your loved ones, but for the ones caring for the loved ones. I mean, this could really multiply in a very exciting way that is beneficial far beyond that just initial purchase, but yet this got you in the door, literally. Now, I have one more question that I think is really important for Russell to answer for us. Russell, what are the long-term goals that we can consider in making these purchases? Because this loan exception goes for manufactured homes as long as it's a double wide, condos, as long as they're Fannie Mae qualified, single family homes. So there's a large variety we can do here. Even, hey, if you want to buy your family member $1 million home, hey, what's the long-term benefits there? We're at the coast, so I'm always dreaming of the beach.
That's a real good point. Main thing I'll tell anybody is when you're planning something like this, just make sure you're really doing what you're saying you're doing. That's stay out of trouble. Okay.
Absolutely.
So you're buying for a parent. Let's say you want to do this. Everybody agrees this is a great thing, and that happens for a year or two, something like that, and they just need to move back in, or hopefully not, but if they pass away, or just things happen. Again, life happens. And so if that happens, then, okay, what happens? So now I own a property, it's vacant. What, are there rules? No, as long as you've satisfied the rules before, and generally in a deed of trust in North Carolina specifically, it's, hey, this is going to be the occupancy we're going to do for 1 year. After that, if you decide you want to change it into a rental, maybe a short-term rental, you're at the beach, like you said. There's all kinds of special tax loopholes that are just came out in 2025, short-term tax rentals. Turn to a long-term rental, sell it, make sure that now we're talking about extra level, and I would never answer this question. Talk to your CPA about, hey, the 2 out of 5 years occupying as a primary residence, and we sell it. Are we gonna have to pay capital gains on this or not? There's a lot of things to talk about and weigh out these options. Do I sell? Do I rent? Do I short-term rent? Do we move into it? Maybe another family moves into it. There's so many options there, but mortgage-wise, as long as you do in the beginning what you're really saying you're going to do for enough time, you're okay. And another point you mentioned, types of homes, but also the amount changes every year, but the conforming loan limit is $806,500. So we're not talking $200,000 here. If you want to buy what may be considered a luxury home, $1 million or something like that, you can do that, as long as we're not exceeding that conventional loan limit size. So, really good point there. And involving the CPA in that really all of us in all these life changes and transitions, you talk to your experts, and there's attorneys involved in this, all kinds of things too. But you involve all the experts, you'll find that instead of being possible pitfalls, there could be opportunities. And I want to finish up by thanking everybody here, thanking you for watching this. But I want to tell you where all this came from. And many years ago, I had a client that asked me about buying a home for their adult disabled child that was right next door to her, wanted to have independent living for her son, and did not have 25% down. And so I went to my head underwriter, one of the smartest guys in the mortgage industry ever, and researched and everything. So you know what? And then came up with this guideline and said, here, 5% down, primary residence rate, the whole works. And that made my wheels turn. And then I go straight to asking CPA related questions like, hey, can this be a write-off possibly? Can this be this? Can this? What kind of ways can it help the adult disabled child maybe continue benefits because they don't own the property and everything, not disqualified because of that. And I got excited about it. So I talked to my client. This is exactly what I've been needing, and she was so happy for her son, and that just excited me. I wrote some articles on it, and then here years later we've closed mortgages like this, and now we have this expert panel here, and we all work together often, and we're able to take it from one little scenario to now taking it to you, the masses. That the older population is the largest segment of the United States, and there's a huge need, and we're just talking about one thing here. There's so many things in insurance, real estate, mortgage lending, accounting, and then gerontology. That's just things that we haven't even touched on. So reach out to us. Our contact information is in the video and listed below. Call us, email us. We're here to help. And again, thank you so much for your time and listening to us today.